Hey everyone, super microcomputer stock is absolutely soaring, and that has a lot of investors asking, could super microcomputer stock do a stock split sometime soon? Well, I'm going to answer that question in this video. I'm also going to highlight what that could mean for super microcomputer stock investors. What does stock split mean that you're going to get more money or make more money from super microcomputer stock? That's an important question as well. So I'm going to answer that in addition to answering if I think that stock will do a split sometime soon. So let's get into this.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, super microcomputer stock is trading at $736.79 as of this recording. That's up from around $300 per share a little bit earlier in the year. So could the stock do a split? Well, that remains to be seen. However, I'm going to argue that investors shouldn't really be concerned about a stock split. And I'll tell you why. Let me show you this diagram here that I like to use a lot. So here I have obviously a picture of a pizza in several slices. And you could think of a company as this whole pizza here, the whole pizza. And you could think of the share price as slices of that pizza. So when you're buying a share of a stock, you're buying a piece of a business. You're buying a piece of the pizza, right? So the bigger the piece, the more you're willing to pay. The smaller the piece, the less you're willing to pay. So let's look at one slice in particular, this one slice of pizza. Let's say this one slice of pizza is trading at $2.50 per share. $2.50 per slice. Now, this other slice is also $2.50, right? This one is $2.50, this one is $2.50, this one is, they're all $2.50, right? But you're buying one. What if I was to tell you, I'll combine these two slices of pizza and sell it to you for $5, right? So $2.50 and $2.50, but instead of selling it to you in two different slices, I'm going to combine them and sell it to you as one slice for $5. But you're getting the same amount of pizza and you're paying the same price for the same amount of pizza. You were getting one slice for $2.50. Now you're getting what equals the two slices for $5. So you're not getting any more value for your money. You're getting the same value for your money. You're getting the same pizza for your money. It's just the way that I've cut it up. I've decided to not cut it where I cut it before, combine it, right? And the stock split is this action in particular, right? It takes a pizza, right? This one pizza, let's say it's $2.50 again, and it says, you know what? Let's slice this up in 10 different pieces and sell it for 25 cents each. Instead of selling the whole pizza at $2.50, let's cut this all up and sell it for 25 cents each. You're still getting the same amount of pizza for your money, but now you're buying smaller pieces. No difference in the value you're getting. No difference in the pizza per amount of dollar that you're paying. So that's what's happening with the stock split when you're looking at a stock split. There's no difference. There's no extra value that you're getting because the stock is now split into smaller shares. And a lot of investors get confused about this. They think a stock split is something good, is something that's going to add value to the business, is something that makes the stock more attractive. It really doesn't. It really doesn't make a difference. It really doesn't. It creates enthusiasm, it creates publicity, it creates the illusion of being more affordable because now it's at a smaller price, but you're also getting less. And so it's not like you're getting any more value, you're just paying for a smaller slice. And that confuses investors sometimes, so that's why I went to great lengths in this video to highlight this example so investors can understand you're not getting any more value. You're just getting a smaller piece at the same price per piece. And that's why it's important. I highlighted earlier, I was looking at the market price. The market price doesn't tell you how much value you're getting. That just tells you the price. As with anything you go shopping for, right? You're all consumers. You all clearly have money to spend. Otherwise, you wouldn't be watching a video about making an investment because an investment requires money and you probably have money to invest. So when you go to spend your money, regardless of what you're buying, whether you're buying a car, whether you're buying soda at the grocery store, whether you're buying a travel package, whether you're buying a membership to a gym, whether you're buying a streaming subscription, whatever it is that you're buying, you're evaluating the value you're getting. What are you getting for that price that you're paying? That's what's important, the value, the what you're getting in return for the price you're paying. This is just a price. If I was to tell you I've got a travel package for you, $1,000, how would you know if it's a good value or not? Well, what if I were to tell you this travel package that I'm selling to you for $1,000, it used to be $1,700. Would that make it a good value in your eyes? Probably not, right? You still need more information. Just because I told you it used to be 1,700 and now it's 1,000, does that all of a sudden make it a value? No. You need to know what you're getting in that travel package to know whether or not you're getting a good value. That's why in addition to the price, in fact, the price is almost irrelevant. In addition, investors need to look at what you're getting. So you look at valuation ratios like the price to free cash flow. This is what you're paying for the free cash flow of the business. For Supermicrocomputer, that is 27.15. That's what you're getting. Now, you can also look at the price to earnings forward ratio. This is the price you're paying for the expected earnings per share of the company over the next 12 months. This price is 25.89. This is the highest it's been in the company's recent 4 or 5 years, given the increase in the share price. So the stock is getting more expensive. It is getting more expensive. You're getting less for the price that you're paying because the price has increased. This is what investors need to look closely to. What about the price to earnings ratio? This is the price you're paying for the company's earnings in the previous 12 months. And this is also increased to 57.08. And this is the most expensive it's been for Supermicrocomputer going back the last 5 years. So whether or not Supermicrocomputer stock could do a stock split, the likelihood is that it is in position to do a stock split because whenever stock prices approach these levels, companies like to do a stock split because it generates publicity, it generates excitement among investors, and it creates the illusion that the stock price is more affordable. Although none of those things are actually happening. The stock price is not more affordable. They've just cut it up into smaller pieces and the valuation hasn't changed. The stock price is a fraction of where it was before the stock split, and the value you're getting is a fraction of where it was before the stock split. Just like a slice of pizza. I could sell you a bigger slice at a higher price or chop it up in smaller slices and sell it to you for a lower price. What's important to you is not the way I'm cutting the pizza. What's important to you is the actual pizza. How much pizza are you getting? Is the pizza a tasty pizza? Is the pizza one that you want? That's what's important, not how I'm slicing up the pizza. If I did it in a certain smaller slice, would that make it any more attractive to you? It really shouldn't, because it doesn't matter with the slicing of a share price. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.